5 great companies with potentially great compounding and future growth potential. Stock number 1, Starbucks. Guys, I own Starbucks. Remember, never buy a company because I or anyone on the internet owns it. Find a process. We're here to teach a process. And I'm going to tell you why I own these companies. Starbucks, great brand, selling for $80 a share. In and of itself means nothing. All-time high, 126 3 years ago. It's not insanely off. Yes, it's down a third, which is a lot, but 52-week low, just about a month and a half ago of 71.80. Now, Starbucks has gone through a lot of issues, a lot of things lately about, I do think there's going to be a lot of upward pressure on their costs because of the fact they've already provided a lot of great benefits to their employees. But as time goes on, as the minimum wage goes up, they're going to have upward pressure, even though they don't necessarily pay minimum wage. But I like the company. It has $4 billion in free cash flow last year, which is significantly higher than the 5-year average of 2.76. They pay out a pretty hefty dividend, though. It's the only thing I don't like about the company. Guys, a lot of people love dividends. And I think about this weekend about dividends, thinking to myself, has a company ever 50 or 100 times grown because of dividends? No. But stock repurchases, yes, done at the right valuations. Now, Starbucks here is selling for 23 times last year's free cash flow, 22 times last year's PE. It's a premium company. You should pay a premium for it. Look at its return on invested capital. Very high. This is a moat kind of business. This return on invested capital kind of shows that. They have 38,000 locations worldwide, still growing. As Africa grows, as India grows, they're going to be growing even further. When I hear people say, oh, Starbucks is so passe, I'm like, really? Because how many coffee companies have started in the last 40 years have competing with Starbucks, and Starbucks still gets that premium dollar, the huge money per cup of coffee. So I look at this company thinking, okay, that to me seems like great potential. Let's go check out the 8 pillars. Remember, the 8 pillars are telling a story. What's the story here? Well, the first one I'm going to look at is this long-term liabilities to free cash flow, 11. Guys, this is retail. So my guess is there's a lot of leases. They need these leases. So I don't necessarily view this as debt. Yes, it is debt, but it's not like debt from a Microsoft that doesn't need to have that debt, doesn't need to have the office space, things like that. They need retail leases in order to operate their business. So this doesn't worry me as much. Now, I'm glad their shares outstanding hasn't been decreasing by too much because I look at their PE, 5-year PE and 5-year price to free cash flow. It's a little high for me to be buying back shares. This is very important, and in past videos I've talked about that buying back shares is only value add to the investors if done at a discount to intrinsic value. The hard part is, what is intrinsic value? That's what we're always trying to figure out. Okay, great return on invested capital, 5-year cash flow growth, almost $3 billion. The 5-year net income growth, only $800 million. So much bigger free cash flow growth in the last 5 years than the last for net income. Why? My guess is there was some big drop in free cash flow 5 years ago that has since rebounded, because to have this kind of big discrepancy is a little too much, okay? Now, before I do Stock Analyzer tool, I want you to remember, you can buy great companies and have them compound to big returns, but it's not going to happen in 2, 3, 4 years. You've got to let that parabolic chart grow on itself, right? I asked the question recently, do you realize that getting 10% returns over 40 years will give you 45 times your money? Just doing market returns. That's the incredible power of compounding. 5.9% growth for 40 years still gives you 10 times more your money 40 years from now than today. That's the power of compounding. So when you buy great companies at good prices and let them build on themselves, you can get the 40, 50, 60, 70 time multi-baggers that everybody's looking for. The hard part is, along this path is a lot of this and a lot of news out there telling you how the stock you're buying is terrible. So let's see what the analyst estimates are for Starbucks. Earnings per share. Guys, this is pretty good growth. 367 to 644 in 2028. Look at these. Double-digit growth for such a large company, but double-digit earnings per share growth. Another reason to give it a premium. This company is a premium company. Revenue growth, not as much, obviously. $37.5 billion to $52, 2.5, 7.8, 8.3, 10.5, 8% revenue growth for this company. So still pretty solid. They're going to open more locations. There's still a premium company that's going to get a premium price for their product. Okay. So the question is, what's the company worth to us right now? So I'm going to pull up the last time I did Starbucks. It was back on May 21st. Now, I did revenue growth of 5, 7.5, and 10% over the next 10 years. I did profit margin of 10.5, 12, and 13.5. And their free cash flow is consistently, except for the last 10 years, and the last 5 years, consistently lower. So I went a little bit more conservative on the low side. I did 10, 12, and 14. For PE, guys, I did 17.5, 20, and 22.5. Could it be higher? I would absolutely agree with somebody who put a higher multiple. How much higher? I don't know. But this is Starbucks. If you poll 100 people and ask them, what's the best coffee brand? How many are going to say Starbucks? That's the kind of premium we're talking about here. That's what I'm talking about when I say these companies deserve a premium. If I gave you $100 billion today and said, go compete with Starbucks, it'd probably be pretty difficult. So that kind of brand awareness, that kind of brand loyalty, that to me and to a lot of people deserves a premium. And this is the difference of Paul today versus 3 or 4 years ago. I want to buy premium companies and pay that premium price for it and let them compound. And finally, I just did my 9% desired annual return. The market return average is 9 or 10%. So this is basically saying, what's my intrinsic value for the company? Of course, you need to put in margin of safety. And when you do that, if you have the software, you're putting in the higher desired return there to allow you to work on what the right price for you is. So I hit the analyze button. Boom. Low price of 60 to 65, high price of 150, middle price of 100. So I'm looking at this saying, this is a 20% discount to my middle price. If I pay today's price, including dividends, if my middle assumptions occur, I should make a 12% return on my money based on that discounted cash flow model. Stock number 2, Cisco. Guys, I always go to Cisco to show you. Cisco was the NVIDIA of 2000. Go look at the articles written. Cisco just surpasses Microsoft to become the world's #1 value company. Recent articles, NVIDIA just passed Microsoft. Look at this, guys. Cisco, all-time high, March 27th, 2000 at $82 per share. It has never hit that price since. And for those of you who wonder if the business is better or not, it is way better today. I'm going to show you right here. Income statement, $55 billion in the last 1 year. Back in 2000, it did $19 billion. So almost triple. Profit back in 2000, they actually lost $1 billion. Nope, sorry, I'm wrong. They made $2.7 billion. In the last 12 months, they made $12 billion. So 4.5 times the money. Better company. Price is lower. Why? In the short run, stocks are a voting machine. In the long run, they're a weighing machine. Now, does that mean Cisco is worth what it's worth today? I don't know. It's currently selling for 15 times the price of free cash flow with a pretty decent return on invested capital. Is this a premium company? I don't know. But that return on invested capital is pretty solid here. Now, let's go see what the 8-pillar story is here. Only 1x. Cash flow was down over the last 5 years. That's a big difference in their net income being up. Analyst estimates for this business, not many analysts out there, not much growth. It's fine. Revenue growth, not much there. So this is a company that I think should really focus on buying back shares. They've only bought 4.5% of their shares back. They might want to cut this stupid dividend of 3.3%. It only eats up half their free cash flow, but they may want to start focusing on buying back shares, especially if the stock price keeps staying lower. So let's go see what the stock analyzer tool says to us about Cisco the last time I did it, which was on May 2nd of this year. I did not do much revenue growth. I did 2, 3, and 4%. Profit margin, 20, 22, 24. Look at this free cash flow. Consistently higher than their profit margin, which we love. So I did 24, 28, and 30. PE, 12, 14, 16, 12, 14, 16, and desired return of 9. Now, I did go lower on the PE and price of free cash flow. Is it reasonable today at 15? I don't know. But I don't hear much about Cisco in terms of what they're doing. I wish they were buying back a lot of shares, which is called cannibalizing themselves. They're paying a big dividend. I'm okay with this. I hit the analyze button. Okay. I have a low price of 35 to 40, high price of 56 to 70, Middle price of 45 to 55. Again, paying today's price of 47.50, about 11.5% return over 10 years with that dividend. Now, remember here that even if the stocks go lower and lower and you buy it, it's likely to go lower even still. If you can't buy a stock and watch the fundamentals get better or stay the same, but the stock price fall in half, figure out if you really want to buy stocks. That's the key to making a lot of money long-term on stocks. Buying them when the prices get better. Because remember, your goal is to buy when value is bigger than price. You don't know what's going to happen with that price. It can fluctuate wildly in any given 6 months, year, or 2 years. You've got to have the belief in the fundamentals. Now, guys, you've noticed that we have a waiting list for our Everything Money software and community. And the reason for that is because the software as it exists today includes everything we have to offer for stocks, retirement, and real estate. But we are making some major changes behind the scenes. So in a short period of time, that full offer is going away. As we've been getting feedback from our customers, people want to focus on one thing, and they don't want too many options when they're using Everything Money software. There's so much here. We have all of these tools. It can get overwhelming to offer too much. Now remember, I built this software selfishly for myself, for my team, so I could use it to continually help make my right investments for stocks, real estate, and the right decisions for my future self for retirement. Now, the reason the software is created for you was because we kept seeing comments from people. How do I get that software? How do I get that software? How do I get that software? It started in an Excel sheet. But as we've grown, obviously this has to become less about me and more about you and how we can serve you better, which is why we are updating our software to give you exactly what you need. Now, the good news is we haven't made these changes yet. So if you join our wait list and you're able to get into this, you'll be grandfathered in for life. You'll get all the tools for life because this is the best deal we're ever going to offer. I'm telling you this now because there's still time for you to sign up. And as long as you join the EM community before we make these changes, you'll be able to keep the plan even after we make our changes. So if you sign up today, you'll get all the tools forever. So click the link in the description below to get access to everything we have to offer, our exclusive communities. It'll be the best decision you've ever made. Stock number 3, Southwest Airlines, another company I own. And of course, don't go out there buying companies. Falling to 28.64. Guys, during COVID, it was like at 24, 25 bucks. I've been fortunate to buy this company a couple times, watch it run up in price, got taken away from me for covered calls. But this is a company that's very interesting, and here's why. I look at this income statement. We have record revenue in the last 12 months, record revenue last year, the year before. After COVID, it obviously fell pretty hard. They've been struggling to make money, but I don't think it's a permanent problem. It has to do with their computer systems, all their discounts they're giving to people, these Boeing issues because they're a 737 company. Southwest does very well by hedging their oil bets, as well as keeping one plane for every single aircraft they have. That's how they sit there and focus and become efficient. Now, that one plane happens to be a Boeing 737. Boeing has come through a lot of scrutiny lately. So, is this the example of this company being permanently changed? Look at this. It's amazing to me. In the last 5 years, their profit margin has been 0.6%, and last year was 1.5%. But let's see what it was before COVID, because this is the interesting part here. Okay, before COVID, in 2019, they did $22.5 billion in revenue with profit of $2.3 billion. That's about 10%, a little over 10%. My point here is this is not a 2% margin business. My entire thesis is based on Southwest being one of the best run airlines out there. Now, guys, the interesting part is look at the 8 pillars. It's absolute crap. That's why I always tell people the 8 pillars tell a story. That's why the 8 pillars are so important in our software to sit there and look at it and say, okay, what is this telling me? To me, this is telling me, based on Southwest history, that this is absolute garbage. This company is either going through a turnaround or it's going to end up being a terrible company. Now, my bet is that it's going to be a better company. Could I be wrong? Absolutely. It's not like their profit went from 10% down to 8%. Guys, it went from 10 to 15% down to 2%. I don't think that's going to be consistent forever. Could it be a temporary thing? Absolutely. But fear is pretty big on this company, and they've diluted some owners here, increasing their shares outstanding by 16%. Now, of course, their debt levels look huge, 72 times free cash flow. Yeah, but their free cash flow is terrible in the last 5 years, $188 million. So, again, is this going to be consistent with Southwest for the future? My thesis is based on no. And if you can buy this company at the right price, and of course, the next question is, what's the right price? Well, let's look it up here. I did what I consider to be pretty conservative growth assumptions, 2, 4, and 6%. Guys, I didn't even go high on my profit margin. I did 8% on the low side, 13 on the high, 10 in the middle. It is a premium airline. 16, 19, and 22 on the PE and price of free cash flow. And again, my 9% return. Hit the analyze button. Guys, 52 on the low side, 140 on the high side, 85 in the middle. A lot of potential here. A lot of potential. Do they need to get back to their normal profit margin levels? Yeah, but guess what, guys? At 8% profit margin, it's still 50. My lowest assumption is still a $50 stock. So I like this company for that long-term potential. Stock number 4, Visa, $280 per share. This company is selling at major highs. The all-time high was March 21st of this year of $290. Now, the interesting thing about Visa, guys, is it has all the attributes of being an expensive company. 28 times last year's free cash flow, 30 times last year's earnings, 36 times 5-year free cash flow. They paid this paltry dividend of 0.7%, but it eats $4 billion of their dividends, of their free cash flow. But I want to show this because this is exactly the kind of investor I'm changing into. Do I want to pay a premium for Visa? Absolutely. Why? It's all over the world. It's the #1 overall used credit card brand. If this company went under, what would happen? What would this world look like for this company to go under? The question is, what's the premium that's appropriate for Visa? That's the question on every company you invest in. If you want a premium company, how much of a premium is justified? If you're trying to buy what's called the cigar butts that Ben Graham talked about, companies that were going to crap, how low of a discount do you need to justify it? Now look at this company, 80% gross margin. That means for every dollar they bring in, 80 cents of that goes to profit. After taxes and overhead and everything, their bottom line profit is 50 to 55%. That's big numbers. Very big, because they're doing transactions. And my guess is if they increase their transactions by 30% tomorrow, their overhead is going to stay the same. So with great margin and great gross margin, they can really build on that momentum to increase their profit. And look at their returns on invested capital. Very high. That's indicative of a moat status business. 20% in the last 5 years, 24% last year. Big time growth. Now, the 8 pillars here. What's the story here? Story here is it might just be a valuation issue. Everything is up. Free cash flow is up $7.8 billion versus 6. They bought back 18% of their shares. Now, guys, 18% on an expensive company might seem like a lot, but they keep justifying higher and higher numbers. Where were they 5 years ago as a stock? Last 5 years, they're up 60%. They were at around 170. That's a pretty big growth level. And I would argue that 170 today would be a buy all day long, but we'll see that shortly. Let's see what analyst estimates are. Look at this growth rate in earnings per share, double digit. Premium company, guys. And again, I'm trying to teach a process. You can apply this to anything you're looking at, whether it's real estate, whether it's any other sort of investment for bonds, for example, buying a certain company's bonds versus another company's bonds, buying a city. This is the point. You have to sit there and pay a premium for value, but you still need to remember that every investment is the present value of all future cash flows that you're going to get. And the more you pay for those cash flows, the lower your return is going to be. But at some point, it's a good value. And if you determine that Visa is a great value today, again, you need to be ready for the stock to go lower. You can't expect great returns in 6 months. It takes time to let things build. But just know that over a long period of time, the stock price will be dictated by the earnings and the fundamentals of the business as long as you pay an appropriate price for the business day one. That's the key here that I'm trying to teach. And guys, look at their revenue growth. Almost double digit. This is a company that's still growing. As Africa, as India, as China becomes more and more economically independent and strong, this company is going to grow along with it. That's an absolute fact. And that's what I want everybody to remember when looking at this company. So let's look up good old Visa. in our stock analyzer tool. So I went a little more conservative. I did 5, 8, and 13% revenue growth, but I want to point out one thing. Look at their returns on invested capital. Getting better as time goes on. That's awesome. Profit margin, 48 to 53%. Free cash flow, since it's higher, 50 to 58. And I put 20, 24, and 28 for my multiples of earnings and free cash flow because premium business. My 9% return, hit the analyze button. The stock's currently at 280. I have a low price of 170, high price of 450 to 500, middle price of 250, 260 to 275 with no margin of safety. I have my watch list at 235. I'm actually going to increase that. Remember, guys, as time goes on and fundamentals get better, your watch list price should increase along with it. So I'm increasing mine at 250, not to say I'm buying at 250, but to say I'm going to take a deeper look and maybe sell some puts so I can be paid to get the stock at lower prices. Final company, Nike, great brand, $97 a share, all-time high of 180, essentially on November 5th, 2021, 2.5, almost 3 years ago. And guys, this is a company, pays a dividend that eats up $2 billion of its cash flow. 5-year average free cash flow, $4.5 billion. Last year, 6.2. Great return on invested capital. Good margin of 44 to 45% for gross margin, 10 to 11% for profit margin. I mean, let's look at this story here with the 8 pillars. Again, it's one of those companies. Is this the appropriate premium for the company or is it an X? They haven't bought back a lot of shares. I'm actually happy about because the stock was pretty hefty for a while. But maybe it's time for them to start getting aggressive about that because 24 times free cash flow, I don't know. Maybe it's appropriate. It's quite the brand, guys. If I did the Family Feud survey, name the #1 sports apparel company, how many would say Nike? It's a question to ask yourself. That's a very important question to ask yourself. Not a lot of debt in this company. And analysts for earnings per share, a lot of growth here, 378 to 636 over the next 5 years. It's a lot of growth. These companies that are established, they can still grow their earnings per share by those kind of numbers. Yeah, the revenue is not going to grow a lot, but they have a decent gross margin that can really add to that bottom line. And that's what's key there. So, of course, we're going to jump right to what is Nike worth to us. And this is why it's important for you guys to check out the community and check out the software because you need to be able to make your own assumptions and use this thing like crazy. So revenue growth, I did 3, 5, and 7%. Profit margin and free cash flow margin, 10, 11, 12. I did 20, 23, and 26 for both my price to earnings ratio as well as my price to free cash flow and my 9% desired return. Hit the analyze button. I got a low price of 60, high price of 120, middle price of 86 or so. So guys, these are the 5 companies. Remember, in order for these things to go up multiple times, you got to let them compound for a long period of time. Thank you very much for your time.